Guys, welcome to the fifth topic, which is foreign exchange. It's actually not too difficult. It can be a little bit confusing as there's a few little tips and tricks to this, but it's really not that difficult, especially the chapter is not very long. It's one of the shorter chapters in the Fin module. But I'll basically teach you the tips and tricks, so once you know that, it's actually quite a simple process and an easy question to get in an exam. So basically, a lot of companies these days are dealing with foreign markets, and I guess the accounting standards needs to come up with the correct treatment as to how to treat those foreign exchange transactions, and also the second part to that is also translating your actual financial statements at year end to a different currency. For example, if you have a subsidiary overseas. So the first part is actually dealing with transactions themselves. For example, you're an Australian company and you're buying something, you might make a sale to New Zealand or buying stock from New Zealand, and the transaction is denominated in New Zealand dollars. You need to know how to account for that so that transaction is reported in AUD. And it does get a little bit trickier when it's over a long period of time. For example, it's not just settled on one day. For example, you might raise an invoice and have trade receivables on one date and receive the cash at a later date, in which time the exchange rate has changed. How do you treat for that? So I will step you through the steps, and the relevant accounting standard is IAS 21. So this one is quite simple. So a foreign currency transaction is initially recorded by an entity in its functional currency. So functional currency, for example, for an Australian business is AUD, because that's the currency that they operate in. It's the currency of the primary economic environment in which the entity operates. So, for example, we've got an Australian company, its market is in Australia, but it makes a sale outside of Australia, for example, New Zealand. You're going to have to convert that New Zealand dollar into the functional currency, which is Australian dollars. So, how do you... This is split into two sections, so initial recognition and then subsequent reporting. So initial recognition is actually really easy. So that's when you've actually made the sale. So to recognize a foreign currency transaction, the spot exchange rate. So this is the exchange rate on the day of the transaction between the functional currency and the foreign currency. So the exchange rate between the AUD and New Zealand dollar exchange rate in this example. So you recognize the sale in New Zealand dollars, you just convert it on the day of the sale. If you receive cash on the same day, super simple, that's it. It is a little bit difficult when you have subsequent reporting periods, however, and this is where the actual gains or losses can arise, because you've got that difference over time in exchange rate. So the initial exchange rate is quite simple. We talked about that, it's just the spot exchange rate on the day. In this example, however, we're going to talk about a situation where a company is actually raising an invoice. So they're going to recognize the sale on the day at the spot exchange rate and the trade receivable at the spot exchange rate. However, when they actually receive the money or revalue it at year end, you're going to have to recognize a gain or a loss depending on which way the currency has gone. So, subsequent reporting. They're talking about here when you come to end of financial period, usually 30 June for Australian companies, you need to be able to revalue that amount. And there's three sections that they've categorized out. So foreign currency monetary amount. So in this case, trade receivables would fall under this category. And then you'd use the closing rate, i.e. the spot exchange rate at the end of the reporting period. So in this example, we're using a trade receivables account, which is a foreign currency monetary item. And you would use the spot rate, exchange rate between Australia and New Zealand at 30 June to revalue it. The other categories are non-monetary items that are measured in terms of historical cost in a foreign currency. Non-monetary, for example, could be cost of goods sold, or it could be an actual asset. So you'd use the exchange rate at the date of the transaction. And non-monetary items that are measured in fair value in a foreign currency. So obviously the difference between the two is fair value, you revalue it to market value at end of financial period, whereas historical cost, you might either have a write down or a depreciation cost if it's a proper PP&E item. So they're changing value, you have subsequent measurement. However, which exchange rate do you use for that depreciation, etc. If it's at cost, you use the exchange rate at the date of the transaction, and if it's at fair value, you use the exchange rate at the date when the fair value was measured, which is usually at the end of financial year, 30 June. Okay, so let's moving on. So because of that subsequent measurement or revaluation at the end of financial year, in layman's terms, you're going to have a gain or a loss generally, depending on which way the currency has gone. Now this tells us how to treat for that, and it's basically saying you recognize the item in a profit and loss in the period in which they arise. So you're going to have a gain or loss item in the actual P&L. So here's an example down here that we're going to go through just so you can kind of see how we account for transactions, converting foreign transactions. Now keep in mind that we're only up to the first part, which is just transactions, and later on we're going to deal with actually retranslating financial statements if you're in different jurisdictions. So how do we deal with this in a practical example? Okay, so in this example, there's a company here which has purchased a new machine which will produce handbags. Now they purchased it from the USA for US $12 million. The key milestones are customization and delivery, installation, and preparation for use. Okay, so let's talk about the first transaction. So initial deposit of $6 million is due at the completion of the machine's customization, with the balance of $6 million due when delivery, installation, and preparation for use is complete. Okay, it's a 30 June year end. Okay, so first thing we have to do is we have to recognize as soon as the contract is signed the future liability that the Australian company has to do because they've incurred that liability. Okay, so the date of that transaction is when they've entered the contract is 1st of July 2013. And they've told us up here that the exchange rate is 0.9. So the standard journal is going to be a payable on the one side, the credit side, and the debit side is going to be the capital work in progress because we're using manufacturing accounting. And this is an asset that you're entitled to, so you have to recognize that amount. So capital work in progress. So this reflects the dollar value of the equipment that's being built. So in $12 million US, in Australian we convert it at the exchange rate at that day because it's the transactions, we use the spot rate. So it's going to be 12 million divided by 0.9 equals 13.3 million Australian payable, and then 13.3 million capital work in progress. Okay, so this is just saying that because of exchange rate differences, there's likely to result in a gain or a loss when we actually have to revalue it or the next transaction is actually incurred. So the second journal entry is to recognize the payment of $6 million on completion of the first milestone. Okay, so the next transaction is at 30 September 2013. Now keep in mind that our first payment was on July, so we've already missed our financial year by 1 day, so the next time we have to revalue it's going to be at 30 June next year, so there's 12 months from that date. So really the only next revaluation or transaction is going to be the next payment. Okay, so they've recognized the payment of $6 million on completion of the first milestone in September 2013. Okay, so now we actually have to account for the cash being paid. Obviously, your cash is going to go down in your bank account. How much is it going to go down by? It's going to go down by the spot exchange rate on the date of payment because that's how much money that you're actually paying on that date. So the amount of that is $6 million US because the US dollar hasn't changed and never will. But the exchange rate does change because the exchange rate on 30 September is 0.92, which you can see up here. So we recognize the cash transaction is going to be credit cash because your cash is going down equals 6521739, which is 6 million divided by 0.92. Okay, now the other side is your payable amount is actually reducing. How do we calculate that? Well, it's basically half of your existing payable is now disappeared because you've now made payment of that. So we're just going to divide this by 2, which is equal that dollar amount there. So we're reducing our payables by half. Now, what goes in this account is basically the difference between the two. So it's basically that minus that equals the foreign exchange gain to make the journal's balance. And we're going to record this in our P&L. Now, the third journal entry is to recognize the final payment. And again, it's a very similar approach. The final payment is due on 31st of December. It's $6 million, that's not changed, US, but the exchange rate has changed. So 6 billion divided by 0.93 equals that. That's how much Australian dollars cash they have to pay on that date. Same thing with the payables as before. It's literally just the original payable amount divided by 2 and the difference goes to foreign exchange. It's a gain because it's actually gone in their favor. They've paid less than originally was anticipated. Now, the final generally is just to recognize the transfer of capital WIP to property PP&E. So capital WIP is the work in progress. They've finally finished that. Now they actually have to transfer it across to the PP&E account because it's actually a plant and equipment asset. So you're literally just reversing the original journal and transferring it across to PP&E. As the capital WIP is a non-monetary item, it is not restated at year end. So this falls back to this original amount here. So non-monetary items that are measured in terms of historical cost in the foreign currency, because it's a PP&E item, it's not foreign currency, it's not fair value, and it's not foreign currency item. We don't revalue it at year end. So there's no revaluation, it remains at the original cost. If it was trade receivables or something similar, we would revalue it at 30 June, and we'd likely have another foreign exchange gain or loss amount depending on what the exchange rate is. Okay, so that's how the currency transactions interact. It's not that difficult, really. The second part is a little bit more tricky. It's actually the translation of financial statements themselves. So this occurs when you actually have to translate your P&L, which is and balance sheet in its functional currency, which you talked about in the above example was AUD. However, the financial statements must be reported under IAS 21 under what's called the presentation currency. Now, how do we determine what a presentation currency is? We determine that a functional currency is based on its primary economic environment. However, what the presentation currency on is determined is these factors here. So it's the currency which influences sale prices for the entity's goods, the currency of which which competitive forces or regulations mainly determine the sales price, the currency that influences labor, material, and cost of goods sold, etc. So sometimes these are the primary factors. If they're not available, go to the secondary level, and then if they're not available, go to the additional indicative factors. So it's generally it's a view of it's management needs to make a judgment as to whether what's your functionary currency and what's your presentation currency. Sometimes they're the same, sometimes they're not. There's no straight answer. It's really coming down to using the facts of the case to determine what the case is. Generally in a question, they will tell you what the functional currency is and what the presentation currency is, and generally in a question they'll be different, because if they were the same, then there's no need to translate the financial statements at all. So generally they'll be different in an exam question. However, in reality, that's usually not the case. So how do we actually translate a functional to a presentation currency? So there's certain rules depending on whether the accounts fall under assets and liabilities from the balance sheet, income and expenses from the P&L, as well as equity balances in the balance sheet as well. So equity balances generally end up being the true up, so where you put the difference between all the assets and liabilities in one currency and the other. It generally goes into the equity balance through what's called the foreign currency translation reserve. And we'll talk about that shortly. So let's start off with assets and liabilities. So this one's quite simple. It's just your balance sheet. It's whatever your closing rate is, i.e. what's the date at the reporting date, which is generally 30 June, but it could vary depending on your jurisdiction. Quite simple. Income and expenses. So this is the exchange rate at the date of the transaction. Now, this is a tricky part because this always comes in first. It's always the date of the transaction. If there's one significant transaction which makes up the bulk of your income and expenses, you need to use that date and convert that first, and then the rest of the transactions you can use an average. However, you can only use an average if they occur regularly throughout the period, so there's no like one-off or two-off transactions. And also an average rate can only be used if the exchange rate doesn't fluctuate significantly, so if the exchange rate is stable. So keep that in mind. That can be a tricky part of questions sometimes. If you can't rely on an average exchange rate, you need to actually use the exact date of transactions themselves. So keep that in mind. Equity balance is a little bit trickier, and it's mostly tricky just because of all the little rules. But if you understand how it works, it's not that difficult. So basically, the general rule for equity is you use the spot exchange rate when you acquired the entity, so when you acquired that equity, or when you issued new equity, for example, when you incorporated the business, when you created that new company. That's generally the rule. And any movement after that, for example, you've issued new shares since you've acquired it, or you've put in new transfers to and from reserves or to and from retained earnings, that would be at the date of that transaction when you transferred it in. So it's generally when you bought it or issued capital, and then anything after that, it's the date of that particular transaction. So it's quite simple. That's the summary of these amounts here. So for example, share capital pre-acquisition. So at the date of you acquire the entity, every equity amount relating to that, it's just the date you acquired it. So that's generally before the current financial year. And then anytime you make a new movement, for example, new issue of shares, you use the date that you issued those shares. And that's pretty much it. Same for reserves, so pre-acquisition balance, and then new movements. Same for retained earnings, and same from distributions from retained earnings, so dividends, etc. Okay, so this is another trick here. So foreign exchange translation differences arise because different exchange rates are applied to different balances. Yeah, we knew that above. However, the difference between foreign currency transactions and recognizing foreign exchange translation is that currency goes through the P&L, right? Your gains and losses go through the P&L. However, retranslation does not go through the P&L. Instead, the exchange rate differences go through a separate component of OCI. So it's not actually in the P&L, it's below the P&L through the OCI, other comprehensive income. And the balance sheet side will go to the... Oh, there we go. Cool. Okay, so let's go through an example here and kind of show how the two different rules interact. So we're going to have to consider in this case the foreign currency transactions and also the retranslation of financial statements. So in this case, there's two examples. There's the foreign currency, which is New Zealand dollars. You've got your functional currency, which is AUD, and you've got your presentation currency, which is Great British pounds. Okay, so how do we do this? So first of all, we go through the transactions. So Dinkum sells inventory to a customer in New Zealand for $5,000, New Zealand $5,000 on 15th of the 5th. Payment was received later in July. Now keep in mind, July is after, in between those two dates, there's an end of financial year reporting. So we need to consider the adjustment to that trade receivable balance. That's the first trick of this question. There were 6,000 other sales that occurred evenly throughout the year. Okay, so we're mainly going to focus on this $5,000 transaction because we're just focusing on foreign currency transactions. Okay, so the first thing we want to do is on the 15th of the 5th, recognize the trade receivable amount and also the revenue. So first of all, what do we remember? We remember that transactions are done at the spot exchange rate, so the date of the transaction, which was made on the 15th of the 5th. So the way we calculate that was we take our $5,000 exchange rate and we divide it by our exchange rate on the date of the transaction, 1.08, and that gets us to AUD 4630. Now, it's important to remember which way you're converting, so you don't divide it the wrong way or times it the wrong way. So if we're going from New Zealand to Australian, we need to divide it. However, if we're going to Australian to Great British pounds, we need to times it. The only reason is it depends on which currency you're starting with. Are you starting with the amount that you want to translate to or not? So just keep that in mind and just think in your head before you do the calculation, am I dividing it or timesing it? So because we're going from New Zealand dollars to Australian dollars, we want to divide it because the Australian dollar amount is lower. Just keep that in mind. Okay, so that's how we calculate the 4630, and we want to recognize the sales revenue and trade receivables. Because we're only going to 30 June 2015, we're not going to recognize the cash coming in. We're only going to recognize the retranslation. So we know that with foreign currency transactions, we need to recognize a remeasurement, a subsequent measurement at 30 June. So how we do that is we do that at if you remember back to the original table, it's going to be the exchange rate at 30 June or the reporting date. So in this case, it's 30 June, which is 1.12. So basically, we take the full amount, the $5,000, divide by 1.12. What do we get? We get a higher amount, and it's basically the difference. Sorry, a lower amount, and there's the difference between that and the new exchange rate. So we need to reduce our trade receivables by $160 because it's a lower amount that we're going to receive. And the other side goes through our P&L to foreign exchange loss. So that's really simple foreign currency transactions. Now the other side is actually how do we translate the financial statements, because the results are reported in GBP. That's their presentation currency. However, their functional currency is AUD. So how do we do this? Well, we go through each of the assets and liabilities and convert that at the closing rates, as we talked about before. We go through income and expenses and we convert that at the transaction dates. Anything that we can't put a specific transaction date, we'll use an average rate, provided that it's stable and the transactions are regular. And the exchange rate differences to the foreign currency translation reserve. And the movement is actually in the OCI account of the P&L and OCI. Sales is not remeasured. And okay, so let's go through this example here. So bank account. Current assets and liabilities, really straightforward. So we just said above, it's going to be at the closing date. So what's the closing date? 30 June. So we look at the exchange rate and it's going to be 0.48. So if you put that in your calculator and do that times 0.48, again remembering, are we dividing or multiplying? In this case we're actually multiplying because we're going to Great British Pounds as opposed to the other way around. It's going to be 6,000 times that exchange rate at 30 June. We get to our bank, trade receivables, etc. Now, what else do we do? We're going to leave the equity, because what we have to do is we actually all have to insert the difference between all of our exchange rates through the foreign currency transaction reserve. Okay, so let's come back to the equity. Let's do the P&L now. So we know that sales revenue, we're going to convert the transactions at the date of the actual transactions themselves. So sales revenue, we're going to convert at the date of the transaction, which is the 15th of the 5th. And then we are going to convert the rest of those transactions at an average exchange rate. So it's going to be a combination of the two. Cost of sales, again, is there a specific transaction for that one? No, there's not, so we can use the average exchange rate, so it's just going to be 0.5. Gross profit's just the sum of those two. Foreign exchange loss. So foreign exchange loss is the amount we recognized here. So we're going to exchange that one at the date of the transaction as well. So the date of the transaction was the 30th of the June, so we're going to use that exchange rate there, which is 0.48. And the last part here, so now we've got our GBP P&L, we've got our GBP assets or balance sheet. The only thing we haven't done is equity. So if you remember the rules, we've got to think back, when did we acquire share capital? Because it's not the closing date for equity, it's the date that we acquired it, and any movements will be the date of that transaction. So when did we acquire this entity, or when was it incorporated? It was incorporated on the 1st of July 2014. So that's the exchange rate we have to use. So this exchange rate is 0.47 here. So that's the exchange rate we use for share capital. So it's 4,000 times 0.47 equals share capital. Retained earnings is exactly the same. So it's just going to be what's our original retained earnings that we acquired, and then what are the movements of that, and use that exchange rate. And the only last step is the difference, which goes to the foreign currency translation reserve, which is a difference between all of our numbers, just goes in there, the foreign currency translation reserve. And that's pretty much it. So the foreign currency transactions aren't that hard. The foreign currency translation of financial statements is a little bit more difficult. But again, if you know those tips and tricks and understand how it works, it's not that difficult. There's a small section here on disclosures, which I won't go through in detail. But that's pretty much it. So it's a relatively short chapter. And we'll move on to the next chapter, which is fair value measurement, in the next video. Thank you.